Today I'm doing a rough valuation of Facebook, FB. Facebook is currently selling at $142.31. It has a market cap of $411 billion. PE ratio is at 40.97. It has shown a progressive increase in the market price from about the mid-30s in 2013 to today's price. Current return on equity is 20.03%. Debt is near zero. Its competitors include Google, Microsoft, Twitter, and its size is approaching the size of Google and Microsoft, currently at $411 billion. It has shown good earnings that are climbing, and the trailing 12 months show that to be $27,638,000,000. The free cash flow has also gone up and is currently at $11,617,000,000. Its net profit margin is impressive and has been growing since 2010 at 18.85 up to 36.8% in the trailing 12 months. Its recent quarterly growth year to year is 0.51, which is higher than Google and Microsoft. Next, its 5-year average percent increase in net income is currently at 59%. Continuing, the net profit margin as of December 31st was 48.51%.
What is intrinsic value? Intrinsic value, as mentioned by Warren Buffett, he said, we define intrinsic value as the discounted value of the cash that can be taken out of a business during its remaining life. Now, anyone calculating intrinsic value necessarily comes up with a highly subjective figure that will change both as estimates of future cash flows are revised and as interest rates move. But despite its fuzziness, however, intrinsic value is all important, and it is the only logical way to evaluate the relative attractiveness of investments and businesses.
Now, a preliminary intrinsic value estimation on valuepro.net using 5% growth is 1.47, and the fair value on GuruFocus is 50.68. However, this did not account for the higher growth rates. If we insert the 20% growth rate, the fair value jumps to $112.68 on GuruFocus valuation. Using that same 20% growth assumption, my model reveals an intrinsic value of $140.18, which is close to the current price of $142.16.
Valuation as a whole is improved if you do a couple of areas very well. Qualitative valuation plus quantitative valuation equals better valuation.
The ideal valuation process is an intelligence gathering operation where we should weigh both the subjective and objective findings to find the most appropriate estimation model, and you can adjust your model to your own assumptions.
The model that we use is, in our opinion, a decent estimation model, but it has to be applied very carefully. And basically, it is a two-stage discounted free cash flow model for the quantitative estimation of intrinsic value based on the real free cash that has been earned. What we do is we take an assumed percent growth for years 1 to 10, and then we flatten it out for years 11 through 15 with zero growth for the years 11 through 15. So there are two phases of growth in this model, and starting at time 0 up until the end of year 10, and then 0 growth from years 11 to the end of year 15. After you do that, you add up all the free cash flows for those 15 years, and you discount it back to present value dollars, and then you divide by the number of shares outstanding. And if you have a bargain price, then you have a margin of safety. Finally, don't forget to discount the total free cash flow back to the present value using a reasonable discount rate, and don't forget to divide by the number of shares outstanding. My first book was The Four Filters invention of Warren Buffett and Charlie Munger, and in this book I talk about why this is a major advance in behavioral finance. After I had done my research by reading all of their shareholder letters going back to the Buffett partnership years, I came to realize that they were good investors to begin with, but they showed improvement as the years went along. And around the 1977 letter, there was a recurring phrase that we'll discuss here in a minute. But I came to realize that their genius in their four filters process was to capture all the important stakeholders for business success. And as I go along, you will notice that the first filter deals with products, the second one deals with enduring customers, the third one deals with managers, and the fourth one deals with Ben Graham's concept of margin of safety. Now, filter number one is to understand the business and its products, or the economic understanding. So seek to understand the business and its products. Filter number two is seek sustainable competitive advantages, or sometimes he calls it enduring competitive advantages, or other times he mentions durable competitive advantages. Filter number three is to seek able and trustworthy managers. This is difficult to do, but like they say, they may be able, but if they are not trustworthy, you'll end up losing money. And then finally, bargain price is a margin of safety. By purchasing at a bargain price or a price below the intrinsic value, you get a built-in margin of safety at the time of your purchase. Here is an example from Warren Buffett.
It's just a question of A, can I understand it? If it makes it through that filter. B, does it have some kind of sustainable long-term competitive advantage? If it makes it through that filter, how do I feel about the management in terms of their ability and honesty? If it makes it through that filter, what's the price? And if it gets it through all four filters, I sign my name to the chair.
By adding all these things together, one can improve the decision-making process. So to summarize, the genius of Buffett and Munger's process, it captures all the important stakeholders for business success. And here are the four listed side by side. Understanding the business, well, that covers the area of products. The sustainable competitive advantage, that covers the area of enduring customers. The able and trustworthy managers covers the management portion of the business. And then finally, Ben Graham's concept of margin of safety, or buying below the intrinsic value.